Thank you for the introduction. Thank you for inviting me to be there, even though, well, I am not there, as was explained. And allow me to start by a little bit thinking about Mr. Larsson and his comments early on when he said that he was really happy to be there. He was happy to see an audience. And I was sitting here in Riga thinking, I wish it was me also, right? Anyway, I was invited to come here to give a short presentation, a keynote speech. So I have some slides that I would like to share with you. So give me these here just 15, 20 seconds to try to share my screen and put up my slides, and hopefully it's going to work out. Otherwise, Justina will send me messages in the chat box. So just a moment. Here we are, share, presentation, share. Getting it on, and then it should be there. So I have a bunch of slides, some 25 or so, but don't worry about that. It's going to go faster than you think. It's not very deep, I think, what I have, but I hope that there will be some points of view that might be of relevance and might be of interest. See, as an economist, this is sort of my job, right? It's my job to look into the crystal ball and then try to come up with predictions about the future. That's roughly speaking what the job is for many of us economists. Problem is that these days looking into the crystal ball is a little bit tricky because of all of this here corona pandemic. Usually we economists, we have some background information, we can sort of see how the economy is moving, but what has been going on the past half year has, of course, been rather different. Anyway, we can still come up with some conclusions and so on, and that's what I will try to do. But allow me to sort of move on here, right? I'd sometimes like to use this slide, especially, I must say, this year, old quote from Donald Rumsfeld, who used to be defense minister in the United States. It's about the known knowns, but especially the third part, of course, about the unknown unknowns. And that's, I would say, very much where we are right now. 1 year ago, I had no idea that there was something called coronavirus, and neither did anyone else. And nobody had an idea of what it would do to the economies, right? Definitely an unknown, and therefore also a little bit harder to speak about what's it gonna do to the economies that we have. The way in which I will go forward will be in the following way, a little bit strange perhaps, comparing with the financial crisis, even though these two things they have not so much in common, but they have something in common. So there's something to learn from the financial crisis, even though it was very different. And when I, in red there, try to say I will try to fit it into the panel discussion, I don't know if I will, because I'm not quite sure what the panel discussion will revolve around. And also the presentation by Swedbank doesn't mean that I'm not interested in the other presentations. I very much am, but I'm just not so much an expert on that. I'm more into the parts there that are a little bit more related to macro. And then, as it says in the third part, I'll put a positive spin on the outlook. I shouldn't have used the term positive spin because that means that I'm not being honest, but I'm trying really to be honest here. And I think it's the outlook for Lithuania as well as for Latvia and Estonia is actually comparatively good, right? It's not perfect. We would all have liked to live without this pandemic, but given that it's there, we are in sort of comparatively good shape. At least is going to be my point of view. So here a little bit comparison with the financial crisis. When we came into that, all three Baltics, we had serious imbalances in our economies, overheated labor markets, massive current account deficits, huge credit booms, huge real estate booms, and so on. And you could say, as I write there, we were very much in the eye of the storm. Right? If some countries really could be hit by the financial crisis, it was us, because we were these overheated economies that really could suffer from a stop of credits. Now in this, as some call it, the great lockdown, almost all over the economy, before it started, we were sort of balanced. There were a lack of imbalances, a little bit labor markets again, perhaps, but I think also economic policy has been quite prudent leading up to this year crisis, which means, or should mean, that we can exit from it also in reasonably good shape. So for me, it's it's a very different starting point that we have here in 2020 compared to what we had in 2007, 2008. And just going into it, right, this is how I would have presented our economies in the Baltics just a half a year ago. You know, bright sunshine with a few clouds, right? A little bit overheating in the labor markets, but otherwise only problems being there of a long-term nature in terms of demographics, of migration issues and what have you. But otherwise, quite frankly, looking quite good. Then suddenly, poof, back in March, everything started happening, right? There's no reason for me to read all those bullets, right? You are more familiar with them, I would say, right? We are in a health crisis, yeah, we have seen an oil price crisis, etc., etc., etc. Right? And it all came super fast. I think things happened fast during the financial crisis, but they happened even faster this time around. Then again, and here perhaps my positive spin starts, and you can see I changed the weather forecast here to not perfect weather, of course, but not such a bad thunderstorm either. But in this area, right, stock markets are not so relevant. Oil price crisis, well, oil price is going down. It's not a crisis for us, rather it's the other way around. And we're neither in a currency crisis nor in a debt crisis. And that's where I would like to continue. So this year, it looks a little bit like, you know, the glass being half full, right? Yes, we see labor market issues, health crisis, obviously, but many of these issues that are hitting other countries, they're not so much an issue for us. We should be happy about that. Allow me to look here at first at a little bit at the labor markets, not very much, right? Here we have the unemployment rates from the 3 Baltic countries. And as we're familiar with, after the financial crisis, these here were dropping and been dropping very significantly. And if I look at it just from a Lithuanian perspective, it's not so smart, perhaps with my PowerPoint, but what I'm hinting at here is that unemployment had come down to such low levels as were comparable with about the summer of 2008, right? The lowest unemployment rates for 12 years, meaning, again, a tightening of the labor market, a little bit overheating again of the labor markets, and therefore, should this pandemic happen, which of course it did, then I should say, sounds a little bit tough, but it happened at the right time. Think about this here, right? What if this pandemic had come in 2009 or 2010 and had added to 14, 15, 16% unemployment that already was the case at that time? Would have been absolute disaster. In that sense, relatively speaking, this year happens at the right time, even though it sounds somewhat strange to say so. And in terms of policy, I also think that we have seen very different results. Back in the financial crisis, I would say monetary policy was to a large extent uncoordinated. Lithuania and Latvia, Latvia and Estonia, none of them were in the Eurozone at the time. Fiscal policy was very slow in those days, and very quickly we came into these austerity measures, which I would say exacerbated the problems at the time, but also coming from that fiscal policy had been way too lax leading up to the crisis. Right now, we certainly have seen that monetary policy has responded very, very fast, already back in March, April. And this time around, we're all 3 of us in the Eurozone, and I will argue that that has been a very big advantage for us. Fiscal policy, also very fast response there by the individual governments that we have, but also this time from the European Union. So very big differences here in terms of the background for the financial crisis, the background for the Great Lockdown, but also very big differences, I would say, in terms of treating this in terms of monetary and fiscal policy in these 2 cases. I would put it like this and say this time around, we're protected by the euro. There has been zero talk about currency risk in our area, but we have, of course, seen that in many other countries, and in some countries they will have a very, very serious currency crisis. Perhaps I'm overstating this point at the moment, coming here from Latvia, right? But certainly during the financial crisis, a lot of the talk in Latvia was about the sustainability of the fixed exchange rate at the time. Right now, nobody thinks about currencies. I really think that this is another good reason for being inside the Eurozone, strongly protected by a credible currency. And in terms of fiscal policy here, I allow myself to use a graph of government debt as some sort of indicator of, but how much maneuver room do we have for fiscal policy? And that's where all three Baltics also stand out very well. Debt levels are very low as a share of GDP. They will rise, and they will rise significantly this year, but it still comes from low to not so big. Other countries to the right in my graph there, especially from Southern Europe, much bigger trouble. Already highly indebted, and they will be much more so. So again, should this year happen, then we could say we are well prepared here in the Baltics. And just to sort of drive that point in, I would like to deal with the following graph. If you're familiar with these here Maastricht criteria of budget balance, then the budget deficit shouldn't be more than 3%, so you shouldn't be to the left on the first axis of the minus 3%. And total government debt should not be above 60%. So on the second axis, you shouldn't be above 60, meaning you should sort of try with your economic policy, sort of the simplest version of this growth and stability pact of the EU. You should try to be basically inside the red box. And allow me just a couple of graphs to show the difference that we see in the EU in this here context. This is Lithuania. And no, yeah, forget about 1998, that the box was not invented at that time. But during the financial crisis, 2009, 10, 11, Lithuania was kicked out of the box quite significantly, very large budget deficits that also raised government debt. But then from 2012, 2013, fiscal policy has been very prudent and very much adhering to these rules inside the EU. Lithuania has been inside the box. It's even been running budget surpluses in the past few years, and thereby has also managed to lower its debt. In other words, what's going to happen this year, of course, is Lithuania will again be kicked out of the box. Debt will increase, but it all comes from a very small level. So it's manageable, it's sustainable. Lithuania did its homework, as did Latvians and Estonians. And just for comparison, I have this here picture. This is Italy, 2009, also hit by the financial crisis, then managed to reduce budget deficits and so on. And oh yeah, by the way, I forgot to put in the box, right? And that is sitting there. And what I just get from this here picture is that we have two countries, Lithuania, Italy, hugely different, like day and night when it comes to fiscal policy and also the possibility of using fiscal policy in the future. Lithuania coming from a much stronger background than the Italians. We get this here, this is not so polite, this here slide, but I take my chances, right? That we see this north-south divide in the EU being exacerbated, being strengthened. That's very unfortunate, but we have very big different backgrounds, certainly in terms of our fiscal policies. Then I have this one. I'm not so happy. I'm not sure I'm so happy with this year graph. It's of the economic growth decline this year, estimated IMF. I sometimes think about myself that, hey, let's stop using GDP figures this year. Let's wait until 21 or 22 when we will have an overview of what exactly did happen. Because I agree with the minister, whom I think said it very succinctly, that there are already changes coming on now. I'm quite sure that GDP will decline this year, but then again, there will be these corrections already starting here in the third and fourth quarter. That should mean that the total decline is not so big. Otherwise, I would use it to say, but wait a minute, we in the Baltics, we have already tried this year before. We had it during the financial crisis. This year decline is huge, but we had something that was even bigger in those days. We're a little bit used to this here. Okay, what next? Just very briefly from me, right? And that is that interest rates will remain low. I think many of the bankers in the room can tell me much more about that. But as far as I can see, this is going to continue on and on and on, for years, keeping ultra low interest rates there. Again, the ECB reacted super fast, and I'm dead certain that they will stay on this year course. And there's going to be tons and tons of spending and borrowing this year also from the EU, this new next generation recovery plan. So we have a lot of fiscal stimulus coming to the economies to try to counter the effects of what has happened there in terms of the pandemic. Not so much to be said about that from my side. I think we have all heard about it a lot, right? Some people are then worried about, with all this money being pumped into the economy, will this not be inflationary? Well, not yet, definitely. And I have, certainly I hope that I can have strong belief in and credibility in the European Central Bank that it will stick to its inflation target, right? Right now, they're supposed to pump money into the economy to raise inflation closer to this very specific target of theirs of close to but below 2% in the medium term. And they're far from that still. I hope and believe that they will stick to this year also, so that we will not see any high inflation coming out of this. But when interest rates can be raised, not anytime soon, I think. I've been a little bit kind, I think, to Lithuania. Then I should also be a little bit hard in the end. I'm coming very close to my last points of view here. In terms of this stimulus coming from the EU and this next generation and so on recovery plan, we know that there will be a lot of borrowing taking place. We know there will be transfers. The borrowing will be taking place mutualized. It'll take advantage of the high ratings that we have in many countries in Northern Europe. And here I'm a little bit sad about that. I think Lithuania, Latvia, and Estonia haven't really voiced a very strong opinion. They are parts of this here rather loose Hanseatic League that is fiscally very conservative and so on. But I think they should have voiced a little bit more opposition to this here plan. Are we really in favor of that countries in the EU should borrow in a sort of mutual way? Are we really in favor of that transfers should be directed, in this case, towards the southern countries? Perhaps it should, but it's certainly opening new doors. And I don't think it was discussed enough here in our countries, where we seem to have a point of view that said, hey, as long as we get more money than we have to pay, let's just say yes. I'm lacking some principles there, quite frankly. Last conclusions from my side, very simple, I would say. I've mentioned the first bullet already many times. This country was well prepared for such a crisis. It's very unfortunate that it's there, but should it come, it came at the right time. Private sector, I haven't talked about that, gets a lot of, or has gotten a lot of attention and support, has to be short-lived, right? We have to look at sustainability of public finances, but we also have to have companies out there again, standing on their own feet. I don't see any migration issues coming up this time as there was after the financial crisis. All countries are in more or less same kind of trouble. Therefore, there's really nowhere to move in order to find other jobs. And then I have this one with young people. We saw the financial crisis in many countries really hit, especially the young, especially in Southern Europe, very, very high unemployment rates for them. That's not happening here. Younger people are better off in that context. They're better educated. So we're not going to have this confrontation between younger and older. And then it's something we should be really, really happy about, right? When I look to the world with these super low interest rates, I will see another financial crisis coming. There must be a lot of firms, a lot of financial firms that are looking for some sort of return somewhere. And when some people start buying bonds from Iraq, then I'm definitely getting concerned. And the very last one, will this V-shaped recovery take place? I'm still waiting for full signs. Yes, there will be growth next year. I have no doubt about that, but I'm waiting to see how impressive it will be. But I'm hoping that others will be able to perhaps say something about that as we move along. Then I move out of my presentation. I've been on PowerPoint for the whole time, so I'm not quite sure what has otherwise been going on. I tried to be short here. I was not very deep, perhaps, but I hope there was a few points that might be of relevance. Thank you for this, and I stop sharing.